Hello, good morning, everybody. Welcome back to Economica, all about economics. And yes, welcome back. We have today fresh data from the UK economy, and we see that the inflation rate has surprised to the upside. So we have increasing inflation in the UK, and to me, it's not a surprise. I was expecting higher inflation, and yeah, we see that the year-on-year inflation rate for the month of January jumped from 2.5 to 3%. I can tell you right now that my ARIMA forecast in my previous ARIMA forecast that I did, I think in December, like 1 or 2 months ago. So basically I have a forecast for a nearly 4% CPI. So it doesn't come to me as a surprise that inflation rate is 3%. And we see also here the headline for core inflation, 3.7% up from 3.2%, and core producer price index are up month on month. This is the output year on year that probably will increase in the coming months, and yeah, retail price index are up 3.6 from 3.5, and PPI output month on month, it went from negative minus 0.2 to positive half a percentage point, so this is a net 0.7 percentage increase. The input of producer price index jumped 0.6, so it's in line with the increase in output for PPI. So overall we see that there are pass-through effects of higher producer price index, which have a spillover effect on inflation, headline inflation rate. And as I said in my previous videos, that I will put the link in the description so that you can go and check the video as you like. That the UK economy works or runs with a higher structural inflation, which is due of many factors, which is these factors mostly are supply chain effects, so the cost of imports, which are higher due to Brexit, and this is an exogenous factor. Another very relevant factor is the inflation in real estate asset prices. And yes, the data for many developed economies, which is the United States, UK, or Europe, or Australia, or Canada, we can see across all these economies that there is a clear and evident problem of real estate inflation, like an asset bubble, and it's very difficult that the rate of inflation of real estate asset will continue at this pace, because we have a global real estate asset bubble. And in fact we see that, for example, the UK rent inflation month on month went from 7.6% in December to 7.8% in January. So landlords of all kinds, they are already pushing through new rents agreement at the beginning of the year with the rent hike inflation. So there will be higher costs for housing and also business premises all across the board for the UK economy. And yeah, we see that also services inflation has jumped from 4.4 to 5%. And these are idiosyncratic structural issues of the, I mean, not issues but features of the UK economy, because we have a real estate asset bubble. There is no other way to explain what are the features of the UK economy. And this is evident from many angles, many data. It doesn't matter what is the house supply every year. The problem is the cost of producing things and the cost at which real estate assets are priced. Because if the average price for a dwelling in a new flat in the Greater Babylon, in Greater London, is £500,000 or more, maybe £750,000, then you have a problem of inflated asset prices, real estate or inflated housing market prices, and there is no way this will go on and in a sustainable manner. There would be a reckoning sooner or later for the whole global economy in terms of housing market prices and inflation in the real estate market. And yes, we see here that rent inflation has been steadily increasing for the past 3 years. We are here at 7.8%, and this it won't be decreasing unless there is a correction in the real estate market. And what confirms this data is also the ONS website that shows us how the CPI inflation is 3%, but CPI including owners, occupiers, housing cost component, it's 3.9%. So there is another evident data that shows how housing cost it's pushing having a spillover effect on the UK economy, and this is not only the inflation rate, but it has a spillover effect on the affordability of housing, the purchasing power of real wages, consumer spending, and in the end it affects investment in the economy and economic growth. Because another data which is very important and is highlighted also by many British people is that so many small businesses, they are shutting down. This is the unaffordable cost of doing business in the UK, that it's basically seeing a draining out of capital investment, of gross fixed capital formation, because of basically the higher cost of the real estate, higher cost of having business premises, and this high cost of having doing business then are a direct impediment for having a return on investment, on ROE for businesses. So unfortunately monetary policy the past 20 years, almost 20 years, is responsible since after the 07-09 crisis, and having interest rate at zero for more than a decade. This is responsible for these are the consequences of very cheap money, like very cheap money supply, a huge expansion in money supply, which has then gone exponentially higher with with the pandemic, and this basically has generated a spiraling effect of real estate asset prices, which are basically have been inflating at a very fast pace, especially in the past 3 or 4 years, and there are all signs of a housing market bubble, which is very difficult to basically to contain whenever the market then needs to have a huge sharp correction in real estate prices. And this is basically, I mean, the Federal Reserve is very it's the first guilty party in this global economic global asset bubble, because the money supply in dollars has inflated well beyond any reasonable level, and the higher costs that we see also in the UK economy and in Europe and in all other developed economy and in emerging market economy, it's a cost that it's also a spillover effect of how the US economy basically hoards for commodities, bids prices higher for assets, for materials, for inputs that are necessary for the economic engine to keep growing, to keep going. So it's very simple to understand. The huge expansion of money supply makes more money available to American businesses to bid up prices of everything all across the global economy, whether it's house prices, whether it's real estate assets, whether it's commodities, whether it's industrial outputs, manufacturing outputs. So US business have been bidding up, pushing up prices globally. So this is the inflation in the United States. It's a push through effect on the global economy, also on other economies, and this is bad in the end for the rest of the world, because it comes to a problem of scarcity of supply, and then higher prices for any commodity or asset that are necessary, or energy that are necessary for any economy, which can be the UK, which is a small open economy, or it can be for any other economic area. So the huge money supply, it's a factor of higher structural inflation. Then there are idiosyncratic features of, in this case, of the UK economy, which is very skewed to the construction sector. So we have for the past decade and more, for I think for many decades, since the 1990s, there has been a huge expansion and in building developments in the construction sector. So this basically has built up a housing market bubble and real estate asset bubble, which has increased in its size even after the 07-09 crisis. So it's not an easy thing to solve and to confront with, but nevertheless this would be a very difficult and hard problem for the Bank of England, because there is very little credibility for the Bank of England to say that inflation will converge to 2%. Like services inflation has just jumped from 4.4 to 5%. And rent inflation is 7.8%. Like housing cost, it's 3 or nearly 4 times what is the 2% inflation target. And we will have, going forward, we will have rising producer price input costs, and of course then wages and wages in the service sector will have to keep up with the growing cost of inflation. And so I mean, to my idea, or for what I can see through the data, inflation expectation in the UK economy for the UK consumers is they are well unanchored. They are gone. It's a boat that has left adrift in the sea, and there is it's the Bank of England, it does not have any grip on the inflation expectation and on core inflation and the overall spillover effect of the many components of the inflation basket and the many parts of the economy, to make sure that there is a sort of price stability, or that the inflation rate and the core inflation rate will converge more or less to 2.5%. The interest, we've just seen that the Bank of England has tried to cut interest rate, and but now inflation is going up again. Let's pull up the chart. Let's load up. Yeah, we see that now it's 4.5% from the last meeting, but I mean, a core inflation rate, if we want to discount to a net positive 2% real interest rate, then the Bank of England should be at 5% or 5.7%, 6% according to core inflation. So the Bank of England is taking a risk, and we can see what is the market reaction, because I think the Bank of England risks of a very humbling reckoning, like a I think that, I mean, there is the strong possibility. We see that the 10-year Gilt, it's up 6 basis points now at 4.6%. These are the past January market volatility, and I will put a link also of a video where I explain all the idiosyncratic factors of the gilt market, what is the inbuilt volatility, and how the gilt market is linked. The volatility of interest rate in the United Kingdom, they are intertwined with the real estate asset bubble. So as much as house prices keep going higher, these house prices will push inflation higher, and then the inflation linked part of the stock of debt that through which the UK borrows, then will keep going higher. So we have a component of inflation of the gilts market that is linked to inflation. So house prices go up, inflation will keep up, and then the yield and the coupon that the inflation linked gilt market will have to pay will be higher, and this will have a pull effect on the yield curve. is the same as the TIPS market, the Treasury inflation protected issuance that the US Treasury Department has. So all those bonds that the government issues for fiscal spending, and all those bonds that are linked to the rate of inflation, they will push the yield curve higher. And because we see that they will pull, we see that rent inflation is 7.8% in January, and I don't want to be a tenant that is gonna be receiving a letter from the landlord and say, okay, rents has gone up this year as well. So we see that the higher inflation goes, all the bonds that are linked to inflation will pull inflation, the yield curve higher. And the 30 year it's 5.26%, and it's 12 basis points. So 5, 7, 20, 30 year gilts, they all have been moving by 10 basis points. Also the 52, the 1 year gilt, it's pricing a 10 basis points higher. It's closer to 4.5%. So the 52 week, this 52 weeks, it's the 1 year. You can see the intraday jump. So the 1 year bond, it's closely linked to monetary policy. So the 1 year bond, it's not, it's basically saying, okay, the Bank of England will not be able to cut interest rate for the next 52 weeks. Because the BoE rate, it's 4.5% now, and this is basically pricing 4.44, but it's likely to go higher. So the market reaction to higher inflation rate, it's well contrary to the tentative, or to what the Bank of England has been trying to do, or so to cut interest rate. And I think the Bank of England probably does not, I think it's not fully aware that it does not foresee that inflation probably will be higher in 2025, not only in the UK but in the United States and across the board. And I don't want to sound like, I don't want to exaggerate, but Bank of England, the gilt market could have so much volatility that Black Wednesday could seem a walk in the park. And I don't think they are prepared for that. Nevertheless, of course we hope that things will be stable, but I don't think that the yield curve, for what concerns, what regards the gilt market, will be very much stable. And I will show you in a bit some data. We see that here we are, the 30 year is 5.2%, but I think my forecast is for a 6% 30 year gilt, 6% yield, 30 year gilt. And because we have here housing costs that it's 7.8%, and services inflation is 5%. So if I left to discount this inflation rate and I want to hold a 30 year gilt, then I will have to ask for a much higher yield. There is no way that this thing can be priced in market 5.25%. So we saw today that inflation is higher, and I can show you here my the forecasts that I did in back in December 2024, and I have here a rising CPI towards 4%, which is basically very probable. And yeah, also here other forecasts similar, I mean the same ARIMA forecast of a 8-quarter period. Core inflation will be stable at 4%. We saw just this morning that core inflation is gone up to 3.7%. So to me, the data that are not a surprise to me at all. And I want to go back again to my VAR data. Okay. Sorry for the pause. Okay, let's go back to the gilt market, and I want to show you again this by probability distribution model, which has been worked with a Monte Carlo simulation, and I try to figure out what are the probabilities for the what are the probabilities and of the gilt yield curve to start to drift higher going forward. And we have here the data. So these are based on the yield curve data. The time series, they have at least 10 year of daily data, of daily returns, of daily yield data. And we see here that for the whole 10-year historical time series, there is a 0.97 annualized vol, and this was the market yield when I implemented the model, and was 4.59%. I can confront it with today, which it's today it's higher, is 4.62%. So a few months ago was a bit lower, but I think I was around this period. So we are going back up again, and we see that the model assigns the probability of the yield reaching 5% within 2 years. It's 39%, and 5.5% within 2 years is 26%. And we can see here in the charts this red dashed line, yeah, are the yield 5 and 5.5%, and these are this is the probability distribution, and these are very close to the average yield, which is which was 4.59, but today it's 4.62. So we are at same levels. And again, also for the 30-year gilt, 30-year bond yield, the market was pricing 5.16%, and we see here what is the probability of reaching 6% within 2 years is 25%. So it's very high probabilities assigned by the measure, by the model. Sorry, we see here what is the standard normal, not the standard normal, but the Gaussian distribution, and we see that 25%. So we are very close to the average yield, and this is this chart is for the as a 2-year horizon. And yeah, I can here see, okay, they change. So what did I ask the machine to do? Yes, it was to give me an 180-day forecast for most of the bonds, the gilt market bonds, and the yield curve. So we can go briefly again through the data and see, for example, the 1 month yield was 4.95%, and the range expected, it's between 4.25% and 5.64%. So what I want to say, just to give you a clearer idea, it's that this is a probability distribution model which is based on a parameter. The machine assigns a range, an expected value to this theta parameter, and then on the by working through the posterior mean distribution of all the historical data, then the machine is able to basically develop a probability distribution of what can be in this case 180 days forecast in a 6 months time, what can be the probability distribution of this parameter based on the past historical data. And it does that also utilizing a Monte Carlo simulation method with a precisely is a Markov chain Monte Carlo simulation method. So still is a simulation, but it's not from anything that comes out. It's based on the past historical data. The machine assigns assigns or derives an expected parameter, and then on the by working through the expectation of this parameter, which is the yield, the expected yield for the specific bond maturity, by working through the past data, the posterior mean, so the average yield data, then it assigns probabilities, and it comes out with a range, an outcome range. So the 1 month yield, that's the range, which is 4.25, 5.64%, and the 6 month yield, the range is 3.68 up to 5.92%. So the probability distribution of this model basically already told me that hang on, don't be so sure that the yield curve for what concerns the gilt market will steadily go down. There are probabilities which are not negligible that the yield curve will go up, and this is also due to volatility factors. Okay, so there are economic factors, which is higher structural inflation, and there are also market dynamics for which investors have to basically do risk management. And then when you have a higher inflation rate, then investors, they tend to to sell bonds, because then the yields goes up and the price of the bond goes down, and then you have a volatility effect in the market for what is the bond market. So that's why the probability of what is the range of the yield in 6 months time, it's not at all that the yield curve will go down, but this shows me that the yield curve is likely to go up. And to me it seems that there are tail risks in the bond market, in the gilt market, that there can be some volatility shock, some higher volatility which is not expected. And as I said, I repeat again, maybe Black Wednesday will seem a walk in the park. Anyway, let's see. Yeah, the 1 year yield for the gilt market, the range is 3.15 to 5.89 or 5.9%. And this is very plausible and in line with what is the market behavior, because we see the 52 weeks, it has aligned with the Bank of England 4.5%, so the 1 year gilt yield it's pricing 4.44, which is very close to 4.5%. So the market is basically telling you forget about interest rate cuts. For 1 year, for the next 12 months or 52 weeks, the Bank of England will have to stay at 4.5% because we see that inflation is going higher. And so I could see this well before this data of inflation data of January have been released today, and I can see in my data and my volatility models here we have a very wide range of the 2-year yield, which is 2.7 to 6%. So there is a very wide probability distribution, and so that gives you a very wide outcome of many scenarios or possibilities, basically. Okay, so this is the 4-year gilt. The yield was 4.15%. Okay, again, every time the 4-year. This is not very common debt security. That it's the range basically. It's 2.57 to 5.74%. So it's a wide range, which prices lower yield, but somehow very high. The probability of of a steepening yield curve. Okay, 3-year we see a 2.68% yield to 5.8%. And let's see the 3-year. We have the 3-year. Today it's 4.1%, and it's gone up by 8 basis points more or less. And yeah, the yield at the time, like 2 months ago or 1 month ago, was 4.52%. So it's above 4%. And yeah, the average yield in 100 or after 108 days, this one is basically in line with was the market data at the moment. But we have here this range, which is very wide. It goes from 2.7% to 5.8%, but we see that the market is pricing higher yields. So I'm not so sure that the gilt yield market will be very stable, and we will have I mean that I'm sure that will be there's going to be some volatility in the gilt market. This is the 7-year gilt, 2.79, 5.94%. This is another one. So the 10-year gilt, it has a wide range that goes from 2.92% to 5.96%. And I mean, let's see. Today we are at 4.6%, and a couple months ago we were 4.45%. So we are more or less in the same range, and this tells me that the market is pricing a higher inflation, and yields are higher. So the curve, the yield curve, is gonna be steepening, and this does not exclude that the market, the bond market, will experience some volatility especially if there are some macroeconomic data that can spook investors, and then they are prompt to sell gilts outright in the market. And so here, 9 year, yeah, range 2.9, 5.94, and then when the duration is longer, so the 15-year gilts, then the range is wider and it goes to 6% and higher. So again, the machine assigns some probability that the yield can either go to 3.25% or 6.14% or in between. So it's gonna be in this range. Okay, but when we consider what are the macroeconomic data and how the market is responding, we see that the skewness, the skewness of the probability distribution is for a steepening of the yield curve. So we are in this range, in this direction, yield going higher, and this is not a very nice outcome to have if you are a central bank and you are trying to cut interest rate, and then the market throws the book at your face and say go back to underdegree apprenticeship and see that the yield curve will go higher. And there are risks, there are several risk factors that point to the direction that the gilt yield curve will steepen. So the 20-year bond, the range is 3.4 to 6.26, and the 30-year gilt, up to 6.25%. So we see here the probability distribution, and the market data was at the time was lower than what is pricing the market today. 30-year we see 5.26, 20-year 5.19. If I go back to my data, so 20-year 4.84, today the market is pricing 5.19. So today the market is pricing 5, not 19%. Okay, so the probability distribution of what is the path in 180 days, in 6 months time, of the 20-year gilt yield, it's clearly going into this direction, to 6%. Okay, and this is a probability distribution that I worked through the past month, 1 month or 2 months ago. Okay, so the market today, the 30-year gilt, it's pricing 5.26. So my last data was 4.87. You see the market today is pricing 5.26, and this is not the higher yield, because the gilts market has experienced some volatility during January, and already was talking about that there is volatility in the market. Investors, they are not confident. There are so many factors which are also due to the inflation swap curve, and how pension funds, they have to hedge their exposure to longer duration gilts and to longer duration inflation linked gilts, and how pension funds, they utilize derivatives to replicate the exposure, or to leverage their exposure to the gilt market. So there are so many complicated factors, but anyway, the yield today is 5.26%, so the probability is that of a peak of 6.25%, and the probability distribution according to what is the market data tells me that we are going to the higher, to the steepening of the yield curve, and the Bank of England will find it very difficult to cut interest rate, to find any data that will allow for the bank rate to decrease, because inflation is going higher. But nevertheless, the Bank of England probably it's now today it has it's pricing 4.5%, and this is not giving inflation a real it's giving a very low real positive yield, because core inflation is 3.7%, but services inflation is 5%. So you have a negative 0.5% real interest rate if we compare what is the bank rate and what is services inflation. And then you have negative, if rent inflation is 7.8%, you have negative 3.3% real interest rate. So it's evident that the Bank of England it's in a very difficult position. Bank rate 4.5, rent inflation 7.8. If the math is not wrong, it is a negative real interest rate of minus 3.3%. Okay, and even in the face of services inflation, which is 5%, you have a negative real interest rate of minus half a percentage point. So the inflation data, they are going to push the yield curve higher, and the Bank of England they have all the data, but there could be some higher volatility that they are not expecting, or they believe that the market is behaving in an orderly fashion, and there is nothing to worry about. I would not be so naive about the outcome of inflation data and volatility in the gilt market. So I will love you and leave you for now. And I'll invite you again to watch my previous video about the what are my macroeconomic projection for the UK economy, whether it's higher inflation or moderate GDP growth, and all the other variables. I will leave the link of the video in the description. And for now, have a good day, and yes, please leave a comment or thumbs up for this video, and see you to the next episode.